Everyone, welcome back to Navellier Market Buzz, episode 27. I'm Crystal Navellier, and I'm joined again this week with my father, Louie Navellier, and of course, Jason Bodner, who's the co-founder of Map Signals. Earning announcement season is winding down, but there still are some stocks that we need to discuss. Let's first start out with Target.
Well, Target is kind of a conundrum because it has an erratic earnings surprise history. It's had inventory problems. It's lost some market share, and it's had to, announce 5,000 price cuts. So I have very, very low expectations for Target, and their sales are supposed to be down 3.4%. Their earnings are supposed to be down 24.6%, but the analysts have interestingly revised their earnings estimates higher in the past 60 days from 215 to 225. So that means they might eke out a small surprise. But again, this company's a wild card.
Yeah, I agree. They have a mixed history. They have, strong sales and earnings. 1 year sales growth is down. They are estimated to grow sales and earnings next year, but not huge. This is not a growth company. Obviously, the importance here is that it's basically a thermometer of the consumer. So whenever they come out, a lot has to do with guidance, but really it's margins and gross margins at that to see how strong the consumer is. So I don't have high expectations either, but it's really sort of a key consumer indicator.
I'm sure most people buy their TVs off of Best Buy, so what do you expect for them?
Well, unfortunately, they're kind of in a slump. Sales are supposed to be down 6.5%. Earnings are supposed to be down 11.5%. They did miss last quarter. I don't see hardly any changes in analyst estimates. So they might eke out an earnings surprise. They're trying to get a lot of service revenue from everybody joining the Geek Squad. Yeah, it's pretty lackluster. And based on the latest consumer spending data, it looks like these big ticket items might not be selling.
Yeah, Best Buy ranks 55, so it's sort of right in the middle, mediocre stock. Negative sales and earnings growth on both 1 and 3 year basis. They eke out a profit margin of 3%. So this contraction can't go on forever. Otherwise, they'll slip into negative profit. Their sales and growth estimates for next year are probably not strong enough to make a massive difference. So yeah, I agree. They're in a slump. I'm not expecting great things. That said, the stock's only up 3.3% year to date. So if they come out with a surprise, you could see some upside in the stock.
And what about CrowdStrike Holdings?
Well, this is the company that, in theory, took down the European airlines. If you remember, there was a Microsoft Azure Cloud update that crashed the system, and there was a quick fix, and Microsoft told everybody to upload the fix, but it was on a Friday when I guess no one was working. But anyway, Microsoft didn't blame CrowdStrike. They blamed the EU for forcing their software to be open source and not being able to do the testing they normally do. So, with that said, CrowdStrike got hit. I sold on a dead cat bounce. I don't own it right now, but it is the premier cybersecurity firm out there. Their sales are supposed to be up 22.4%. Their earnings are forecasted to be down 9.5%. The analyst community has been quiet on the stock. I expect them to surprise because they do have a good surprise history.
Yeah, it's a great point. Ranked 70 in my system, mainly on technical strength. So on the fundamental side, this is all about a growth company. So if they don't deliver on their growth metrics, you're going to see the result in the share price. I agree. I believe they probably will surprise. They have slated strong sales and earnings growth for the next full year, 17% earnings, 21% sales. So it's really, this is one of those companies that's in the volatile mode as it grows. So, any miss is going to punish, any gain, any surprise is really going to be beneficial to the share price. So, but it's already strong, up 11% year to date. So, it'll be interesting to see what happens.
No, I'm a big fan of Abercrombie and Finch. I used to buy them when I was younger, and I think that they're great for a lot of women who are entering the corporate field because they have more mature clothing. However, can we expect good things for them?
Yeah, they should announce decent results, but I have to confess I did sell it because it slipped to a D rating in my system. And this is an example how I'll sell something good to buy something better. But I do still expect them to have a positive results. Specifically, their sales are forecast to be up 7.9%. Their earnings are forecasted to be up 19.4. The analyst community has revised their estimates higher from 329 90 days ago to 356. So that's a good sign. So they probably will surprise, and they have a good surprise history. I think the issue with Abercrombie, their guidance after the last quarter was a little not as strong as some people wanted. So the stock kind of lost its mojo on that. But I do expect it to surprise, and I just had to buy something better.
Yeah, Abercrombie and Fitch, it ranks really well in fundamentals, super weak in technicals in my system. Overall, it's a 37.9. This is a company that's just experienced massive earnings growth and, maybe leveling off. The stock has been severely punished, perhaps for fear of unsustainable growth. It's down 32% year to date. With that said, the stock's still up 670% 5 years. So, Louie, your timing was excellent. But yeah, this is really one of those growth retailers or a retailer in growth mode that maybe is hitting a bit of a wall. And that's why the share prices are being punished. So, with that said, any surprise and really any great forward looking guidance could really amp up the shares here. And it's already priced to the downside. So, I see more upside than downside in terms of surprise, what they're going to report, but very interesting company because they are just sort of in a growth lull after a big explosion.
Now, do you see any surprises with Marvell Technology?
Yeah, I expect it to surprise. This is a data center related company. A lot of the data center stocks were hit on Thursday because there was a report that Microsoft was needed less power for its data centers. Whether that's true or not, I don't know. It could have just been an internet thing to hit the data center related stocks. But their sales are supposed to be up 25.9%. Their earnings are supposed to be up 28.4%. We have positive analyst revisions in the last 90 days, 52 cents to 59 cents. So, and they have a good surprise history. So they should beat. It is not in our portfolios yet, but it's an up and coming stock.
Yeah, interesting. It ranks 43 out of 100 in my system. Technically, it's very weak. Fundamentally, it's bang on middle of the road, 50%. And that has to do with negative 1 year sales and earnings growth, negative 3 year earnings growth, and they don't make money. They have a negative profit margin. Bothers me. So I would like to see that swing into the positive. Their shares have been hit pretty hard this year, down 21%. So again, I like these setups where there's technical weakness in the shares. Obviously, we've experienced some market-wide weakness over the past week, contributing to that. But when a share price is depressed and we move into earnings, that's a great setup for a positive surprise. So if you get that positive lift with some fundamental metrics that indicate it's turning the corner, yeah, it will indeed validate that being an up-and-coming stock. But I don't like the contraction that I'm seeing in the fundamentals. So it'll be really interesting to hear what they have to say. Plus, they carry a fair bit of debt, and they don't really have cash on hand when you factor in for their debt. So it's facing a couple of headwinds here.
So I'm sure most people know about Kroger, but actually, fun fact, they became the first grocery store in the United States to have its own bakery. However, what does that mean for their earning announcement?
Well, this is a very, very well managed company, but if you've noticed, the grocery business is more competitive than ever. So not only do we have Whole Foods, we have Sprouts Farmers Market, and now we have Aldi. Everybody's trying to get you to come to their store. Plus, Walmart's selling more food. So is Costco. So unfortunately, Kroger sales are forecasted to go down 5.7%. Their earnings are forecasted to decline 17.1%. The analyst community has been pretty quiet with their estimates on Kroger, and they do have a good surprise history, although last quarter they came in line. So maybe they are profiting from the egg crisis or the meat crisis, because the number of cows we have in America are at a multi-decade low, so meat prices are up. And of course, we have the bird flu getting chicken prices up. So again, very low expectations, but a well-run company.
Yeah, I'm in agreement. Kroger gets a 72. The main contributor here is technical strength. This thing has had a really positive uptrend, just in terms of sustaining its price appreciation. Fundamentally, it's right in the middle, 45.8. They don't really have huge sales growth. They're up 1% for 1 year. Earnings is down 4% for 1 year. And it's flip-flop for 3 years. So 3-year sales growth is up 4%, but 3-year earnings growth is up only 1%. So obviously, this is not a major grower. They're all about sustaining their margins. But that said, the profit margin's only 1%. So there's not a lot of variance here. They're operating like most big box retailers or, food retailers, cost centers like Costco. Huge volume, thin margins. So if there's any variance in the volume, that's going to really affect their earnings report. And then, yeah, you have sort of these key one-offs like meat and eggs with really high volatile prices. But, it's a supermarket. There's not much exciting to say. I really don't expect they're suddenly going to come out and say, we blew away earnings expectations by 20%. If they do, you're going to get a nice lift in the share price, but it's still a $46 billion company. It's sort of plain Jane. I don't expect much from the report.
While we're on the topic of supermarkets, we have left Costco. However, can we still expect good things from them?
Better go up. We own it. We own a lot of it. Their same-store sales growth has been amazing. This company is moving more and more upscale. In fact, Crystal, our local Costco in Florida, has changed. They have repackaged the meat section. So if you want to buy a steak, it's almost hard not to buy a steak that's less than 2 inches thick. Okay. And in huge packages. So they're very expensive. The fish side of their has been moved to a smaller area. I don't know. It's harder to get fresh fish or what, but because we usually buy salmon from Costco. But this company is going increasingly upscale, and they cater to very wealthy consumers. So here's the bottom line: their sales are supposed to be up 7.8%. Their earnings are supposed to be up 10.1%. The analysts have been revising their estimates higher. They have a phenomenal surprise history, and we got to watch gas station sales. That can affect their numbers, but obviously they're a huge gasoline retailer. And then my final comment is we want to watch their same store sales. As long as those are expanding, everything's going to be fine with Costco. And the Kirkland brand keeps capturing market share.
Yeah, Costco, I've also owned it for a long time as well. It's now sort of moved over to a dividend holding as they pay a dividend. It's not a huge dividend, but they are growing it. 1-year dividend growth, 13.5%, which is really nice. Costco gets a 72.4, 88 technical, and 50 fundamental. Now, here's the thing about the fundamentals. It doesn't mean it's weak fundamentals, but I'm really looking for growth metrics. So everything is positive. 1 year, 3 years, sales and earnings growth are positive, but just not by huge amounts. They do make money, but it's only a 3% profit margin. And they're estimated to grow their earnings next year by 9.7%, their sales by 6.9%. They got tons of free cash flow, manageable debt. It's a great company on paper, but it's kind of like Kroger. It's like there's the explosive growth of memberships has kind of run its course. Can it resume? Absolutely. But everybody knows Costco. If you're not at Costco, you're at BJ's. And those are the two big wholesale level direct to consumer markets. But the stock's up almost 250% in 5 years. So any surprise to the upside is going to continue to propel the shares higher, but I'm not expecting a massive, price movement, maybe plus 2 or 3% either direction.
And finally, what about Broadcom?
Well, this is a tech flagship, and it has a very good surprise history. First of all, their sales are supposed to be up 22%. Their earnings are supposed to be up 37.4%. The analysts have revised their estimates slightly higher. Very good surprise history. So I don't own the stock right now, but this is a bellwether and a flagship, and they should be.
Yeah, Broadcom's just one of those great historical growth stories, one of those companies nobody knows who they are, and then all of a sudden they appear on the scene. A major contributor in the semiconductor world. They score a 56.9 in my system. 44 technical, 75 fundamental. So on paper, this thing's a great grower. What I think affected the share price, which is down 14.7% this year, is they had negative earnings growth by almost 62%. That really impacted sort of the growth trajectory, took the stock's knees out from under it. But you look on paper, 1 year sales growth, 44%, 3 year sales growth, 24%, 3 year earnings growth, 12%. You have a 12% profit margin, tons of free cash flow. They do have debt, which, levered 1-to-1, about 100%. But with the share price down almost 15% year to date, a strong surprise history, a strong growth history, I think if they come out and even meet expectations and issue rosy guidance, you're going to see the shares take off again.
Before we have an update on last week, one of our subscribers wanted to know what your take is on Warren Buffett's stockpiling of cash.
Doesn't mean anything significant. Warren's been a conservative investor for a long time. He's had cash for a long time. He's in his 90s. He's getting ready to make a transition. So I don't think it means anything. Obviously, he likes low P ratio stocks. I have no problem finding them in the small cap sector. But he's a big investor, and you have to pay a premium when you buy larger cap stocks, more liquid stocks.
Yeah, I think the news loves to anchor into anything that's going to grab attention, and Warren Buffett stockpiling cash is going to make people bite their nails. But the reality is he's tied to valuation. The S&P's price to earnings ratio is a little bit high, a little bit extended. So that's probably why he's stockpiling a lot of cash. But there isn't a lot of strong evidence that shows he's great at timing market tops. He's the first to admit that he could be off by years, and he just does things the way he does them. And, he doesn't deviate because it's obviously worked for him for historically speaking. So I personally don't put much stake into it. He's selling into what he perceives to be richer valuations, but that doesn't mean they can't get richer for the next few years. So I'm not too worried.
So now there were a lot of good earning announcements last week. Could you give us an update on them?
Sure. Well, I'm just going to go down a list here, and don't be offended by a lot of this. But some of these stocks did go down after the earnings came out. But when that happens, they usually bounce right back. Because I'm about to show you how strong the earnings were. We had a subscriber ask about Axion. That's the company that makes the tasers. We have that under management. They announced their sales were up 33%, which was in line. Earnings were up 112%. That was a 37% surprise. So when a stock gets hit, and there's good earnings to come, you can be patient. So that's why I'm so patient with Axion. I don't want you to worry about the daily gyrations. Revolve Group, which is a retailer we've talked about in the past, their sales went up 13.9%. That was 4.3% better than expected. Earnings were up a whopping 240%. That was 89% better than expected. So, and that stock sold off after its great earnings. But again, that's probably because the news that the retail consumer is cautious. But Crystal, Revolve Group has a very specific demographic group. So that's very loyal to them. So I think they'll be okay. Cava, the restaurant chain, this is very interesting. Their sales were up 28.3%. That was a 0.8% surprise. Earnings were up 3,200%. Believe it or not, that was a 16.7% miss. And so the stock did sell off after posting the earnings up over 3,000%. I was impressed with that report because their same-store sales growth was up 21.2%. So obviously, Kava sells fresh Mediterranean food. They're following the Chipotle model. They're adding stores like crazy. Um, I, I I think the stock will come roaring back. Although the way Wall Street works is they have these algorithms out there, and if you have any word in your announcement like slowing or cutting or or somebody comes out with a report that says you missed or whatever, the algorithms, the computer trading will kill the stocks. So Jason, you're more of an expert in that. Can you comment on how these how the machines sometimes control the market or the tail wags the dog?
Yeah, so a couple of comments. Both Morgan Stanley and JP Morgan issued separate reports a couple of years ago, estimating that anywhere between 70 and 90% of all daily volume on the aggregate stock exchanges are institutional. And out of those, similar percentages between 70 and 90% are algorithmic trading. And like you said, Louis, I'm going back to say 2000 and maybe 10, 15 years ago. I had a friend who was developing algorithmic trading for options, high frequency trading for a hedge fund. And at the time I was working at Cantor Fitzgerald, he asked me for every email we had on all stocks that come across my desk. And I auto forward him. And I was like, you know, dude, there's like 600 emails a day that I get. And he's like, I'm not going to read them. My machine's going to read them. And I have a text parser that parses out text, identifies certain words, puts them in a bucket, and that becomes a factor in my model to decide whether to buy or sell. This was 15 years ago. So you can imagine how advanced the technology is today. It's instantaneous. It's exactly what you said, and it's a major contributor to volatility.
Yeah,
Yeah.
and one last comment I'd have is we've talked about it in the previous episodes, but we showed a chart of the QQQ since inception. That's the NASDAQ 100 from our friends at Bespoke Group. And we showed that if you bought at the opening and sold at the close, you lost 53% of your money. In other words, the daily spreads were bigger than the daily performance. On the other hand, if you bought at the close and sold at the opening, you're up about 3,200%. Okay. So that is, to say a performance dispersion is an understatement. Basically, it means that during market hours, it's a killing field, and people are trying to jerk you around, take advantage of you. And this is when the mean reversion programs go off, or all the short sellers and innuendo reports come out. But the smart money on Wall Street settles up after the close, and that last 15 minutes after the close is when the smart people trade. So often people ask me, "Aren't you worried about what's going on today?" I says, "No, because I'm not stupid. I'm not going to sell in to this killing field and be picked off." And so I usually wait for a bounce to sell earnings or sell stocks, and good stocks do bounce. So if there's any theme here to what I'm about to say on some more stocks, don't worry about them. As long as they have good sales and earnings, they bounce. Another example is Mtron Industries, MPTI, last week issued a preview that their sales are going to be up at least 18.7%. So that stock popped in that news. And usually when a company gives you a preview, the news is going to be good. Navellier, of course, was the flagship. Their sales are up 77.8%. That was 4.3% better than analyst expectations. The earnings were up a whopping 81.6%. It was a 6% surprise. And they announced that Blackwell is 28% of their sales. So Blackwell is their high-end chip for the AI data centers. It's liquid cooled, the most powerful chip out there. Blackwell is going to get more and more of their sales, and they are going to be ramping up here. Now, Jensen, their founder, was very honest. during the conference call saying that, well, we did have to fix one little thing on Blackwell, not this quarter, but the previous quarter, but it's all fixed. So sky's the limit right now. So you may know that NVIDIA sold off, and me and Jason discussed this in the previous market buzz, that there's so many options issued on NVIDIA that the people that are collecting the premiums by selling these call options don't want to deliver the stock. And even though the stock was up briefly, okay, there's always an excuse to hit the stock after they announce. And so there was the rumor that Microsoft is, cutting back on the electricity it needs for data centers. So that took out the whole sector. It was bogus, and the video will be bouncing big time now. There's no better stock than this stock.
You always talk about price to perfection, and this stock exceeds perfection every single time. And yet, I think Jensen Huang also said he expects sales growth to be in the high 70s% by the third and fourth quarter. So, I mean, even veiled in some potential slowing of growth was positive growth. And I think people look for any reason to sell that. But yes, I agree. No better stock. I owned it for a while. It's impossible to find growth like that at that size anywhere.
Correct. And this is by far our largest holding. Their earnings were 21.8 billion last quarter. Earnings. They have obscene operating margins. It's just mind-boggling what they're doing. So to say they have a monopoly is an understatement. Another stock we should talk about is Sezzle. Now, this is one that Hindenburg hit on a short sale report before they went out of business. And this might explain why Hindenburg went out of business. Their sales were up 100.8%. That was a 28.7% surprise. Earnings were up 760.8%. That was a 40.7% surprise. So just so everybody knows, short sellers are scum. There's no reason to hit this stock. Period. Okay. Obviously they squeezed the shorts and it took off. Another stock we should talk about is XPX Technologies. Their sales were up 13.7%. That was a 0.4% surprise. Earnings were up 79.1%. That was in line. That stock did react very positively. Even when you're in line, as long as you are guide properly, your stock often is rewarded. UFP Technologies is another stock I should talk about. Their sales were up 41.9%. That's a 1.7% surprise. Earnings were up 39.1%. That's a 6.1% surprise. So that was a very, very good news. That stock is a bunny stock. It sits and hops, sits and hops. Clearly, it reacted. And then the grand finale last week was Vital Farms, VITL, our chicken stock. Sales were up 16%. That was a 3.6% surprise. Analysts expected flat earnings. They came up, they were up 35.3%. So again, they had a 35.3% surprise. I'm obviously Vital Farms is profiting from the egg crisis, and if you like organic eggs, they make a fine product out there. This is what earnings season is all about to me. I place my bets. I wait for them to drop kick and drive stocks higher. One stock we're still waiting for is Alarm Industries, ALAR. This is an Israeli company. They do websites all over the world. They do a lot of cybersecurity. They have been reporting record sales and earnings. Now, one analyst, Broadcom, cut their price target from 28 to 25. Ever since then, the stock got hit. But I'm waiting for the good earnings to come out. There's always some confusing, sometimes on Israeli ADRs, because they have their actual announcement and then they have to comply with all the ADR requirements in America. So I've been very pleased with that stock, but it is dead in the water till those earnings come out. So hopefully they will pleasantly surprise me again. Also, a lot of these Israeli tech stocks get bought out. And my final comment about Israeli stocks is you got to realize these companies are a little busy. because, a lot of their employees have to go work for the IDF. Israel's had their hands full recently. So they tend to be very curt with their statements and all. But ALAR is the next big one I have coming out.
So now switching over to economic news, what do you expect for the ISM manufacturing PMI on Monday?
It better be up because it turned up in January, so let's hope it turned up in February. That would be the second month in a row of a manufacturing expansion. So if not, it's going to upset President Trump. So that's my comment. But auto sales and airplane sales can impact that number, so we'll have to dig in the details.
And what do you think about the ADP payroll and ISM service PMI on Wednesday?
Let me start with the ISM service report. It better be up, which is about 50, but it's been decelerating rapidly. There's a lot of concern over consumer spending. We did get on Friday's PCE report that personal income was up 0.9%, which is huge, but spending fell 0.2%. So that's reaffirming why consumer confidence might have softened and why retail sales dropped. I think a lot of it's weather related. We've had severe weather for much of the country in January and February, but spring is now coming. Everybody should cheer up. But I need ISM services to keep growing. Otherwise, Wall Street will panic because we are a consumer-led recovery. As far as ADP payroll, that's the private payroll report. I like them better than the Labor Department because they don't have all the weird seasonal adjustments. And it should show decent growth.
What about the US trade deficit on Thursday?
Oh, it's going to be huge because everybody was trying to dump their goods on America before the tariffs kick in. So I believe the tariffs are kicking in now on China. Then a month from now, it'll be Mexico and Canada. It's interesting. When President Trump met Prime Minister Starmer, he said Starmer lobbied very aggressively for no tariffs. We last year we had a $11.9 billion trade surplus with Britain. So because we have more of an even playing field with Britain, Trump hinted that there may be no tariffs imposed on Britain. And I think he's doing that to make an example out of the EU. Obviously, Britain left the EU. And so I don't think we should overreact to all the tariffs, but they are definitely going to hit China. They've already hit China, and we'll see how Mexico and Canada, how they suck up to the Trump administration.
And finally, what about February's payroll report?
I expect it to be erratic. There's seasonal adjustments in February, and I don't think we should overreact to it. But if it is weak, it will just another reason for the Fed to cut. And there's mounting evidence the Fed will be cutting in May or June. And again, I'm expecting 4 rate cuts this year. But most reason I'm expecting 4 is I'm expecting the Bank of England and the European Central Bank to cut an additional 4 to 5 times this year. They've already cut once. So what that means is that as interest rates collapse globally, okay, our treasury yield should follow and also collapse, and then the Fed will follow market rates lower. So I'm out on a limb saying that, but that's what I believe.
Well, thank you so much to you both for answering all my questions. Once again, thank you to you all for liking, commenting, and subscribing. Don't forget to hit the notification bell to know exactly when we post our next video. Also, thank you to you all for all your support on this book. Once again, we're the #1 seller on Amazon for business finance, so thank you so much for your support. Also, we are on Spotify now, and I'll leave the link in the description below. So if you want to listen to us on the go, that's a perfect way to do it. Thank you so much, everyone. We will see you all next week for a new video.